The Federal Reserve just made a big move with another rate cut, and their updated dot plot has the markets buzzing. But here's the thing, the healthcare sector is taking a serious hit as well. Why exactly is this happening, and are there opportunities hidden in the chaos? Let's break it all down. So first, let's talk about the Fed. They've cut interest rates again, signaling their intention to keep the economy moving. But what's really grabbing the attention is their updated dot plot. This tool shows where Fed officials think rates are headed next, and it's painting a significantly different picture than before. In September, the Fed's dot plot suggested the federal funds rate would be around 2.5% by the end of 2026. But now that projections jumped to 3.5%. According to a Bloomberg analysis, the shift reflects growing concerns about persistent inflationary pressures and the need for tighter monetary policy in the long term. Notably, the broader market fell following this announcement as investors adjusted to the reality of prolonged higher rates. So with the broad market weakness, tech stocks, which usually benefit from lower rates, they pulled back alongside other major sectors. The reality of higher for longer rates has sent ripples of caution through every corner of the market. But the real turbulence has been in the healthcare sector. And that brings us to the next big story, which you've probably heard of. Healthcare stocks are facing intense scrutiny, and there are several factors at play here. First, former President Donald Trump recently reiterated his stance on eliminating middlemen in the healthcare system. Trump stated, and I quote, "Middlemen have been taking advantage of consumers for decades, and we're putting an end to it." This has raised concerns about pricing power and profitability for companies relying heavily on PBM revenues or pharmacy benefit managers, such as CVS. Analysts from JP Morgan estimate that regulatory changes targeting PBMs could impact CVS's revenue by as much as 5 to 10%, depending on the scope and timing of the implementation. This is not significant, though, for a company with over $300 billion in annual revenue. Adding to the chaos, the tragic death of United Health Group CEO Dirk McMahon has sent shockwaves through the sector. As one of the biggest players in healthcare, United Health's leadership changes create uncertainty in investor sentiment. According to CNBC, this development has led to a sector-wide decline, as United Health's performance often serves as a bellwether for the industry. This combination of regulatory uncertainty and leadership changes has investors on edge. But does this mean all doom and gloom? Not necessarily. So let's talk opportunities. Even in a pullback, there are often hidden gems. Take CVS, for example. With its diversified business model, including its retail pharmacy and its insurance services, it remains a fairly strong player in the long term. However, investors need to weigh the potential revenue impact of regulatory changes against the company's efforts to innovate in digital health. Another stock to watch closely is Elevance Health. Formerly Anthem, Elevance Health has been expanding its Medicaid and Medicare Advantage services, which are areas expected to grow as the population ages. Even with regulatory uncertainties, analysts believe Elevance's focus on cost management and diversification could buffer some of the impacts. However, revenue growth in their insurance division could slow by an estimated 3 to 5% if Trump's policies are enacted as proposed. These companies have strong fundamentals and may even benefit from long-term trends in healthcare innovation and aging populations. The key is identifying businesses with robust strategies that can adapt to regulatory and market changes. So how should you approach this market? Here's the simple strategy: diversify. Take advantage of rate cuts by leaning into growth sectors, but also consider some defensive plays like healthcare, particularly stocks with a strong balance sheet and a competitive advantage. And remember, the Fed's actions often take time to ripple through the economy. Don't panic sell or buy on emotion. Stick to your plan and make sure your portfolio is aligned with your long-term goals. So there you have it. The Fed's latest moves, the stock market's reaction, and what's been happening with healthcare stocks. What do you think about these rate cuts? Are you buying the dip in healthcare or are you staying on the sidelines? Also, don't even pay attention because I just changed clothes randomly. It's definitely not a new day. But, anyways, let me know in the comments what you guys think. Don't forget to like the video, subscribe for more breakdowns like this about market trends, and thanks for watching. I'll see you in the next one.